Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for October 30th of 2023. Before we get into the chart pack this week, I want to highlight or preface that you'll be producing a special version of Market Minutes. So I've been on the road the last couple of weeks, two very important investor conferences. One, we visited our friends at First Trust, had a chance to visit with a lot of money managers, talk to portfolio managers, people that are working on products to try to help address some of the volatility. And then last week, I went to the Schwab Impact Conference in Philadelphia. And again, had a wonderful chance to go visit with a lot of people in the industry, with various firms, whether they be, private equity, whether they be fund managers, whether they be analysts, visited with a lot of other portfolio managers. I probably had between the last 2 weeks about 25 to 30 really substantive conversations with different portfolio managers, and then a host of other conversations with other people at like Van Eck, First Trust, some of our partners, iShares Global, and BlackRock, Blackstone, a lot of other people. And so I'm going to try to summarize those thoughts in a separate broadcast to kind of, bring to you all the sharing that occurred over the last couple of weeks. And there's certainly a lot of follow-up that I'll be doing over the coming weeks to dig into some of the things that I've learned. So just be on the lookout for that. Well, let's dig into the data this week. We had the GDP number released for the third quarter. A lot of speculation building for that ahead of the release. And so the estimate was calling for about 4.6, and the number actually came in at 4.9. So if you look at this bar right here, this represents the third quarter. Again, it was supposed to be maybe a little bit down here, and then we got a little bit better than expected. And I'll go into some of the internals on why this number was so big relative to the last handful of quarters. Again, you saw back in 22, we had the two negative quarters. We've had a lot of different components within the GDP help these numbers remain positive. And again, I'll show you that in just a second. But, just summarizing the backdrop here with all of the rhetoric about the investment markets, and sometimes I want to be clear that sometimes the equity markets and the economy don't necessarily sync up, but it's clear that we've had a good economy over the last handful of quarters. I just will hazard that I think this is probably the best annualized GDP number that we're going to see in for at least the coming 6 months, I'll guess. Here's a little bit of breakdown on that GDP number that we saw. You can see on the left-hand side kind of the linear progression of GDP dating back to about 2016. You can see the disruption from the pandemic and then the subsequent bounce back, and you can see, some of the dislocations that we've had. But, all in all, if you look at GDP, it does fit a pretty strong trend line. Now, I will have to admit that the number that we got this last time, the 4.9%, you can see that little leg up there in 2023, pretty aggressive, pretty aggressive. On the right-hand side, if you go to the far right, you can see in the third quarter that a lot of that had to do with the gray shading there, and that's consumer spending, which was very, very strong. And we also had a little bit of an inventory build, which gives you a little bit of pause there if you assume that we're heading towards a slowdown. I'm not sure that inventories were necessarily weak. We certainly didn't have much of an impact from inventories in the second quarter report, but it certainly was a negative headwind, a significant headwind in the first quarter after having had a pretty good quarter in 4Q of last year. But you can see consumer spending is consistently positive, and so that's one of those confounding things this year, that spending has remained pretty high. Now, one would think that that number is going to become less significant over time, and then maybe you're going to have lower economic growth because spending is going to slow. And I think that is the consensus the conventional wisdom. I think it makes sense. Government spending is remaining strong because obviously we've got stimulus is still out there, the CHIPS Act, and all of that going on. Housing, less of a tailwind for us, and trade, a little bit of a net negative this quarter, but almost inconsequential. Here we have real disposable income here for U.S. consumers. You can see that number flagging a little bit after having kind of perked up a little bit earlier this year and into certainly as from last year. Again, this kind of fits a trend line. So if it's going to oscillate a little bit around this long-term trend line, I think that's okay. This is actually aggregate dollars. So here, in this sense that we're talking about, literally about $16.75 trillion. But again, it fits a trend line that's very, very close to the trend lines that we're seeing in overall GDP. Now, I mentioned inventories before, and you can see here in the black line, you've got retail inventories moving higher. For the most part, again, this is in real dollars again. So this is not like year over year change or anything like that. This is actually real aggregate data. The blue line represents the real inventories. So if you deflate inventories by inflation, then you get what's in that blue line versus the black line. But you can see inventories are moving higher, and in an expanding economy, this is something that you would certainly expect to take place, and you can see the magnitude at which it has had to meet consumer spending. And so, when we talk about GDP, inventories are important, spending is important. Spending will, over time, soak up inventories and cause you to have to produce more inventories. And going back to that slide a few slides ago when we had the quarter over quarter, and so there's a lot of up and down in inventories, and it can be a very, shall we say, noisy number. But it's very symptomatic of kind of this ripple effect. So I kind of liken this pandemic to like throwing a big rock into a calm pond, and we're still dealing with those ripple effects. And inventory is one of those places where you can see it relatively clearly on a quarterly basis. Here we have durable goods data. You can see in the here in this last on the left-hand side, we've got orders month over month. We were expecting maybe a little bit less than 2%. You can see that we've got 4%, almost 5%. Here is a very, very strong number after having seen a fairly weak number back in the summer. Now we go over here to transportation. It's a little bit more muted because transportation orders can be, you think about airplanes and Boeing, I mean, they can be really lumpy. But if you take those out, this gives you kind of a more, I think, a more usable number, if you will. And so that data has actually been positive. So we've got several observances here consecutive that are positive. And so this data has actually been pretty strong for us as of late. Here we have core PCE prices. You can see the survey there was for 2.5% for third quarter for personal consumption expenditures. Their price index was a little bit less than that. That's good to see. This is a disinflationary trend. This is definitely a disinflationary trend. If you look, starting at this point, this is back in 2021. Really, when we saw inflation was going to be a problem. Fed was still of the opinion that maybe it's transitory, but you can see here this continued deceleration over time. Here we have the annual rate of change in personal consumption expenditures. And I showed this a couple of weeks ago, but I want to just show you really how profound this data is. And again, this is annual rate of change looking at monthly data. And so, if you come over here and you see basically 3 months, over the last 3 months, the annual rate of increase in personal consumption expenditure prices is just a hair above 2%, right? So that's the Fed's target. We don't get this kind of discussion very often, but even if you put that data over the last 6 months worth of inflation data, the annual rate of that data is still only 3%. if you will. And then, of course, we're down at about 3.9% if you look over the trailing year. And that's the number that gets reported more often. But the near-term data is clearly more disinflationary. Here we have the Kansas City Federal Reserve Manufacturing Index. The Richmond Fed data also came out. I didn't post that because it's very similar to what we're looking at here. And so we've got manufacturing index still below the zero line, which shows contraction. New orders down here still in contraction territory and perhaps maybe even getting a little bit worse. So when you look at new orders as kind of like the feedstock to future revenue and earnings growth, then obviously this would give you some pause. And like I said, the Richmond Fed data is very similar. So now we have prices paid. And so if you really want to get a measure of the disinflation that's occurring within the manufacturing sector, you look at this. Now this has evolved from 2021 when we had our peak. But if you look over a longer period of time, you can see that we've broken through that trend line and we're actually in a negative price growth scenario. Here we have new single-family home sales. Not a shock. I think we probably show more housing data than we show of anything else, just because it seems to, be of importance to the average consumer, whether you own a home, looking for a home, or perhaps maybe even looking to sell a home, or even if you're looking to rent. Obviously, this rent versus buy issue is pretty important right now. But you can see here, on home sales that we do have this notable uptick right here. That is a function of builders being a lot more active and buying down mortgage rates. Obviously the existing housing stock for sale is much larger in terms of its number. But but people are less inclined to move because most people have a low mortgage rate, and they're not willing to move for the sake of moving, right? They're going to stand put, and housing overall affordability is very challenged right now. But new single family housing stock is moving higher because we have been in a decade-long undersupply in terms of new homes. And I kind of alluded to this in the prior slide, but this is basically the premium that you pay to own a home versus renting it. And so, when you look at the magnitude of this increase right here, it definitely gives you some color on why affordability is so challenged right now. So obviously, it's much more expensive to buy a home because of mortgage rates, because of average selling prices than it is to rent one. And so, the rental market has been pretty strong and rents have been high. And we know rents typically are pretty sticky when it comes to inflation. And, when you see this kind of dislocation, this data goes back to 1996, so it does encompass the global financial crisis. And, you can see very clearly in this area right here that that we had a dislocation, but not to the magnitude that we're seeing right now. And so this tells me that rents are coming down, but they're apt to remain somewhat sticky for a while, and that's going to probably cap the ability to get really on a more sustainable basis down. Maybe at or 2%, and I think we jockey around somewhere between 2 and 3%. And, I'm beginning to wonder if the Fed should, begin to acquiesce to more of a 3% overall target, even though, as we just saw a few slides ago, that over the last 3 months, the rate of annual inflation is actually very low. Here's a median sales price on new single-family homes. We just told you that construction is fairly robust right now because of the supply and demand imbalance. You can see average selling prices are coming off their peak because you're not getting a lot of inventory. You're not getting really a whole lot of buyers or sellers of existing homes right now. That market, inventory's down, prices are high, mortgage rates are high. And so it's kind of capping the growth on things. And we did get a little bit, I'd say we did get stretched here quite a bit. So you can see this long-term trend line here. We were a little bit depressed, and then here's the pandemic, and then sales just kind of, selling prices, really took off. And of course, we had, the supply chain issues, which kind of helped to accelerate that. We reached a peak, last year, and I'd say we're in this is not necessarily symptomatic of a decline, but maybe a holding pattern at somewhere in this range. Here we have distribution of rates for outstanding mortgages. This is essentially what people are paying right now, and you can see that there's a huge concentration here in, I call it between the 2.75 and 3.75. This is a huge concentration of observances, which just tells you, what we already know, that a lot of people have low interest rate mortgages. They're not necessarily inclined to take on a high mortgage, because those rates are over here now. And so there's not a lot of people in this category, but that number is going to grow over time, right? Because some of these mortgages people will have to move for some reason, and they'll have to take on a higher cost mortgage. And then you'll start to see, maybe this begin to skew a little bit, and then you'll have like a little bit of a bump here. But for now, this is going to keep a lid on a lot of the housing sector, just because people are not going to be inclined to want to give these numbers up. And so, but we will continue to monitor it. Now we'll switch gears here and talk about PMI. This is Purchasing Managers Indices. And just to be clear, there's a manufacturing PMI, and then there's a service PMI, and then there's what they call the composite, which is kind of like a conglomeration of the two. And so this here is a diffusion index. So anything above 50 represents expansion. Everything below 50 represents contraction. You can see the manufacturing line here is right at the break-even point. And so throughout much of 2023, we've seen contraction in manufacturing. In fact, you can make a real strong argument in this period here that the manufacturing was in recession, but actually so was services. So, I'd say the assessments of the economy and coming, and I'll say from Liz Ann Saunders at Schwab, who does a really good job of kind of articulating this, but we saw, a period where service was still weak coming out of the pandemic, where you had that part of the economy that was maybe clearly in contraction, maybe even in recession, but the overall economy wasn't there because, we had other parts of the economy that were still in expansion. And then we had kind of a breakout in services, and then we had the manufacturing quote unquote recession. And Liz Ann calls this kind of a rolling recession between areas of the economy, but the entire economy is not in recession. And I think that's a pretty fair assessment. Of course, this kind of cuts off, and we don't have a forecast here, but to the extent that we're able to kind of hold in this level, in this break-even level for a while, and not dip, have the composite dip down below here. In fact, it's actually up a little bit. As long as we don't have that thing dip down here, then I think there's a case to be made that, we can have this soft landing, but, the jury's still out, and obviously we're still watching that. Here we have government debt as a percent of GDP. I've shown this to you, at least the U.S. data to you recently, but what was really interesting, and I didn't really take stock of this, but the Eurozone is actually pretty flat, if not in slight decline as we're moving higher. And so when you think about this in kind of a deeper, more thoughtful way, what it tells you is that you're going to have some more fiscal discipline in the Eurozone relative to the US. We're going to have to, we got more crowding out, the government's going to have to sell more debt. And that debt's going to be at a higher interest rate. And so there's maybe a little bit of a crowding out effect. And so rates that, the government's going to have to pay on that debt are just generally going to be higher overall over time than what you might see in the Eurozone. And so when you think about international investing and allocations to international stocks and maybe even international bonds too, I think this is actually an important consideration in that, and diversification does work, and we've seen periods of time where international equities have clearly outperformed the U.S. In fact, you can make that argument actually today, looking over the last year. Here we have a quick snippet on energy. We've got global oil supply. And this is pretty profound. We talk about the prominence of, higher crude prices and as that relates to distillates and gasoline, which is a distillate of crude oil here. And you see the U.S. in this blue line here continues to ratchet up supply. And so this is on the left-hand scale. So you can see the U.S. is now getting close to 20 million barrels a day of oil supply. And then when you take out the U.S. and you look at the global backdrop, that's actually kind of flatlining here about 84, 83 million barrels a day. And it actually might be in a slight decline. Well, now we'll get into a little bit, maybe get a little wonky for a second here. So, what I want to show you here on the left, the San Francisco Fed has done a lot of work in this area, and so you see in the black line here, you've got the Fed funds rate, and then in this other line here, you've got the kind of the effective funds rate, and so that's a function of where interest rates are now, and so. This whole concept of, interest rates are higher, it's helping to do some of the Fed's job for it. That's actually pretty true. And so if you look at that backdrop and you say, well, here's the effective Fed funds rate, with those higher overall interest rates. Now the Fed, its target rate of interest is only 5.3, but the effective rate here looks a little bit more like 7. And I'd say that that's fairly restrictive. Now, if you come over to the right-hand side and you look at, where the market pricing, this is adjusted for the term premium in the fixed income markets. But, if you look at long-run Fed funds rate, again, you're looking at like 3.3, 3.4% right here, right? And so, this is a bit of a noisy number, but it doesn't have a wide variance to it. And so, there is some predictability. And this number could go a little bit higher, but this is where we are right now, 5.33%. And so, the argument to be made in this slide is that policy is actually very restrictive now. And so this whole idea of, do we need another rate increase? Well, if you look at this, the answer is a definite no, because monetary policy is very restrictive. Here we have a 10-year yield, looking up here in the blue line. You get down here, what you're looking at is the estimates for rate increases. And so what I was talking about on the last slide is, is there a justification for a higher rate of interest? And I would say no, but the market actually, if you look here, this is a probability of, in the white line here, probability of a hike in November. Well, that is actually going down, right? That's a pretty solid down. But the probability of a hike in December is actually moving higher. And so, the idea that maybe we've got one more rate increase. Now there's, looking out into 2024, there's really no consensus for any kind of rate increase. There still is, a probability that we're going to get rate cuts. And a lot of people are kind of factoring that in. And I'm not so sure that that's going to be quick to come. Obviously, we'll follow it, but the data is too strong right now to kind of let off the pedal, so to speak, on inflation. And we want to see that down. We don't want to choke off the economy, but we certainly don't want to do what happened in, back in 1937, for instance, as the economy came out of that the depression. And then they they lowered rates too soon, and we had like a second bout of inflation, which caused basically a follow-on recession. And so that's what the Fed does not want to have happen. So, but at least for now, it looks like that rate increase, that last rate increase perhaps is coming perhaps in December rather than in next month. Interesting chart here. We've seen a lot of strength in gold lately. You can see gold here, having come off a trough. It's, been in a general downtrend as we've kind of gone through the spring, which is a little bit ironic with rates moving higher and the fears of recession building. This is a Silicon Valley debacle, and so we had a big spike in gold, flight to safety, and then we had a little bit of a risk off, as the S&P 500 kind of went higher, and so gold went the other way, and that's the natural hedge that you want because you own a lot more stocks than you own gold, but when the S&P comes down, you want gold to move higher, and it didn't really. We saw a little bit of extra correlation here in the fall, but gold has definitely rebounded and is acting like it should in these circumstances. Here we got year-to-date returns, a bit of a noisy chart, but we got several different data series represented. Really just looking at the NASDAQ 100. And of course this is dominated by just a handful of the 100. Again, just as the S&P is dominated by the Magnificent Seven, but you can see, right about the middle of the summer, August 1, was kind of the peak in the market. 718 actually for the NASDAQ, and then right on the last day of July was the peak in the S&P 500. And so we do know that the Russell 2000, which is comprised of a lot of small caps, a lot of unprofitable companies, a micro cap, and the S&P 500 mid cap have all lagged that S&P 500 primarily because the S&P is dominated by those 7 stocks, and which frankly is proven to be a bit more volatile. Here we have a little bit of an argument to be made that maybe we're near term oversold. Obviously, we've seen as we look at the track in the S&P 500, we've had basically the end of July as we just saw, and then we've got this downtrend. So we're actually in a technical correction right now. We're 10% off our peak. Again, not to be shocked or surprised by that because you typically see a 10% correction about every 18 months. I mean, this is like normal history. We haven't been used to that. Either we've gotten the big bomb like we did last year, or we get several years of pretty strong uptrend like we saw before the pandemic. And the fact of the matter is that over long periods of time, you tend to get these little 10% corrections. From a kind of a technical standpoint, you can make the argument, these bands represent, kind of the tolerance levels here, I guess, so to speak. So anything below this line would represent a definite oversell point, and consequently, everything above the line would represent like an overbought. And of course, you can see how over time this does ebb and flow, and that's why you get those erstwhile 10% corrections from time to time. You can see when it was overbought down here, we had a downtrend in the market, but then it picked back up. And so, what this tells you is that, kind of closing your ears to the noise of the data, which actually is pretty strong. You could make the argument that the market then, picks back up because it does appear near-term oversold on a technical basis. Here's some other technical indicators. A lot of kind of noise on this chart. We'll kind of first show you the consumer staples market, and so you can see here oversold. How these numbers oscillate. You can go down here to healthcare. Oversold. You look at utilities, which have definitely taken it on the chin this year. Again, oversold, and I think I think there is some weight to the argument, or better, maybe better say, the argument can be made that that the market is apt for a little bit of an uplift here. Well, one of the things to consider, if you feel like you might be in an oversold condition in the market, is to kind of get a sense of what investors are planning on doing. And so this is a survey of JP Morgan retail clients. And and the question that they're asking is, do you anticipate increasing or decreasing your equity exposure in the coming days or weeks? And it's pretty open-ended, kind of a question, something you could drive a truck through. It's so wide. But really, this number, this line here that represents kind of the general feeling of, whether they, the percentage of those respondents that feel like they're going to be increasing equity exposure. And, you can see here, it's been in a little bit of a downtrend for a little bit of a while, and it has to do with market dynamics. But where we are now, as we just showed you, if you feel like you're in an oversold condition, you want this number to be tracking higher, and in fact it is. So, when we hit the peak of the market there at the end of July, then that sentiment has continued to increase, and right now we're at 52%. Again, does this represent like a really, really strong figure? No. But it's certainly more optimistic from a retail investor's perspective than it has been in quite a while. Well, one of the things that we have certainly been talking about a lot is the difference between the S&P 500, the Magnificent Seven stocks, and the gap between the performance there and what we see in the equal weighted S&P 500 index. And in fact, where we are now is, we've kind of unwound a lot of those gains that we saw from our peak, now being in a 10% correction, and small caps have fared even worse. And so the gap between the S&P 500 and essentially the seven stocks that account for 30% of the index versus the other 493 stocks that represent 70% of the index. I mean, that gap is as wide as we've seen it in almost a generation. Fidelity gives us this chart. Urian Timmer does a great job of giving you a lot of information on one page to kind of take into consideration. Here we have a black line here that represents the S&P 500 going back to 2013. And then we have here this data, and so the orange bars represent earnings per share growth, and then the kind of the blue, the purplish pink lines here represent price to earnings ratios. And so there is a typical inverse relationship. If you think about, when earnings are going higher, that means the E in the price to earnings ratio is higher, which tends to depress those PE multiples. But oftentimes you actually do see multiple expansion, which is what we've had this year. So, the market growth earlier this year was really almost all from price to earnings multiple expansion, because earnings themselves were actually negative. And again, if you look into the latter half of this year, depending on what you believe, the estimates are calling for somewhere in the low double-digit range. In fact, one estimate I've seen is closer to 20%. And if that's the case, you get orange bars that are going to look a little bit more like this in the latter half of the year. Now, I don't think we're going to get like multiple expansion, but I think if the market is going to continue in this kind of a near-term channel, if you will, it's going to be driven more than likely by earnings. Now, again, we could be wrong, and earnings could maybe not grow as fast, but earnings expectations continue to beat the estimates, and have for several quarters now. And so, again, I don't think we're going to see a mercuric rise, but as long as the data is not too bad, we should have, at least, maybe if you take the low end and just assume maybe earnings are just going to be relatively flat for a while, right, before they go back up, then what we're dealing with here is maybe a little bit more of like a channel, trading in a channel for the time being, which is not necessarily bad. Again, that's predicated on the data not being too terrible. Some interesting data here, looking at the last 3 months. Now, we're not quite finished with October, but we're likely going to be down. And so, we have been down August, September, and October this year after having a relatively good first half of the year, at least in some of the large cap technologies names. And so, having had this history, we go back over the years and we look at the occurrences where, we've had negative performance, August through October. Again, October is not necessarily a good month, but November is usually a good month. September is usually a better month. August is kind of a little bit lackluster. And so, there are puts and takes, but, we went back in time and looked at August through October. And then when you've had that negative performance in those 3 months, and more often than not, you're actually up for the year. And then November, more often than not, is up. And then the rest of the year following October, which would essentially be November and December, more often than not, you're up, with the exception of 1937 here, which represented that double dip recession following the Great Depression a long time ago. And so this is almost kind of like an anomaly here. Certainly don't expect, that, and we're certainly not coming off a depression. But if you take all these other numbers here, there is a greater likelihood of having a positive rest of the year than there certainly is a negative. And then obviously you can see here, we don't know what's going to happen this year yet, but the tea leaves would kind of tend to suggest that maybe we're going to have a little bit of a positive closing to the year. This is the equity risk premium. This is global equity risk premium here. We're very tight. This is just like the U.S. Number that we showed you last week. This is essentially the forward earnings yield of the market. This would be like the earnings over price minus the global bond yield, which, as we know, those yields are moving higher. And so this is telling you that bonds have become a lot more attractive than stocks. So you're not getting necessarily paid for the yield in stocks, and so it just means that your PE is probably a little bit depressed right now, and that there's maybe a little bit more attractive case to be made for fixed income. This slide we have global manufacturing PMI right here, and so we have the overall index. You can see here that we're treading water a little bit below the line, and now we've kind of back up to 50. We beat the actual observance. The data point was better than the estimate. Again, this is a diffusion index here, so anything above 50 represents expansion. So we're coming back into expansionary territory. Again, this is a global number. This is not the U.S. And if you look at new orders, we've rebounded in that category. And you look at global services, which is a subcomponent of this total index, and it's already positive. And in fact, we didn't see it go negative earlier this year like it was in 22. So the global backdrop, just to kind of reiterate, looks a little bit better to us right now than necessarily the U.S. And we know international stocks have certainly done better than their U.S. counterparts over the last year, and there is a benefit to diversification. That's all we've got this week. Hope you've enjoyed the chart pack. Be on the lookout for a special version of Market Minutes. I'll kind of summarize all the conversations I've had at the 2 investor conferences over the last 2 weeks, kind of synthesizing all of the feedback and kind of the collective wisdom that I think was shared, with probably 25 or 30 different money managers, as well as people with BlackRock and Blackstone, the private equity folks, and a lot of other people that I've run into over the last several weeks. So have a great week, and we'll talk to you again soon.